They say change happens 1% at a time. So what can you do to be 1% better today? You could take the stairs instead of the elevator. You could give a compliment instead of a complaint. Or you could change someone's life. 1% may not sound like much, but for young people in need, 1% can make all the difference. At Future Generation, we invest in a different kind of potential. We're the first listed investment company in Australia that delivers both investment and social returns. Future Generation provides shareholders with exposure to the best Australian and global fund managers. Their job? Delivering a stream of fully franked dividends and capital growth to investors. Our boutique fund managers also have big hearts. By not charging management or performance fees, we can donate 1% of company assets every year towards changing lives instead. As a shareholder, you can decide which of our preferred charities will receive your donation, whether it's helping children at risk or supporting youth mental health. Our carefully selected charities ensure your contribution is used in the best possible way. For shareholders with over 1 million shares, you can direct your donation to any charity of your choice. And as our assets grow bigger and bigger each year, so does the 1% donation. This gives our charities the financial security to think and plan long term. By 2044, we aim to have donated $100 million. And the good news is we're already on the way there, having raised $21 million to date. With your support, 1% can make big things happen. To learn more about how you can improve the lives of our future generations, visit futuregeninvest.com.au.
Good afternoon, everyone, and welcome, one and all, to our 5th Future Generation Investment Forum and the 3rd one in Sydney. I'd like to acknowledge our board and committee members of FGX and FGG, our fund managers, of course, for Future Generation, shareholders from Future Generation and WAM, our Future Generation charities, advisors that are here, service providers and all others. Thank you for making the time. I'm Louise Walsh and I'm the CEO of the Future Generation companies, and I'll be your MC for this afternoon. I'd firstly like to acknowledge the Gadigal people on whose land we're meeting today, and to acknowledge the traditional owners past and present. So this is actually, I think, the biggest event that Future Generation has ever held, and it is our flagship event. So thank you for joining us. I think we've got about 1,000 registrations, and I'd also like to acknowledge those who are present on the live stream this afternoon. Thanks very much to our pro bono service provider and partner Livewire, who are streaming it. And I think we have 4,000 or 5,000 people actually on that stream. We'd encourage you to use social media. The hashtag is FG Investment Forum, and especially Twitter. We certainly love that. And it's become a phenomenon, hasn't it, after Donald Trump. So what's in store this afternoon over the next hour and a half? What you're going to hear is 5-minute presentations from 8 of our best performing fund managers across FGX and FGG. So what you will be presented with is their best stock or investment idea. It's a bit like speed dating, but it's not one-on-one. It's strictly 5 minutes only. So each presenter will get a warning card after 4.5 minutes, so they'll know they've only got 30 seconds left. It's 1 slide per fund manager, so please be aware of that. And in your programs that are actually in your show bag, you'll see some notes so that you can actually see the bios of each of the presenters and also write some notes on the stock picks. So there's no Q&A, unfortunately, from the audience. We just don't have time. We just really want to make this a short, sharp snapshot of these stock picks. But I'm sure you can have a word with any of the fund managers immediately after the presentation, and their details, of course, are in the program as well. Now, as a special feature this afternoon, in the middle of these stock picks, we're delighted to present an in-conversation between Tony Boyd from the AFR and Hamish Douglas from Magellan. I'd now like to call upon the founder and the director of FGX and FGG, Jeff Wilson, to say a few words of welcome and also to present a summary of the stock pick results from the last investment forum in Melbourne in November. Thanks, Jeff.
Look, thanks very much, Louise. And thank you, everyone, for coming along. As Louise said, record numbers. Does it mean it's the top of the market? Yeah, possibly. Because as fund managers, we're always a little bit nervous. Of course, I thank everyone here because as you're all shareholders, without your support, these entities wouldn't exist. But also, a group I have to thank, and again, without their support, these entities wouldn't exist, and that's the fund managers. And I can't thank the fund managers enough. Because as you saw on that video, there's been 21 odd million going to children at risk and youth mental health. The next amount that'll go in October will be about 11 million. So $31 million has gone to support charities that operate in those areas. And of course, we want to thank the charities for the work they're doing. So as a lot of people say, it is a win-win-win. In terms of last 6 months ago, we put the results up. They showed me the results last night, and I said, well, where's my stock pick? And they had forgotten my stock pick. Just to give you a bit of an idea, there's a lot of debate about active management versus passive management. The group of managers that we've selected, and you'll be hearing from today, are all boutique fund managers. So that means they have set up their business. They live or die by the performance of their business. And we believe, and the investment committees believe, that, and studies have shown, and I think Tony Boyd wrote a study a year or so ago, that boutique managers outperform all other managers. Now, in terms of, they were the numbers, the stock I'll pick today, I know it's boring, but I'm going to double up. I know Solly won't be that happy, but it's Myer. Trading in the mid-60s. Obviously, this John King, who's the managing director, has done a solid job initially. We think the share price could easily be $1. So that's another 50% higher than where it currently is. He's taking significant costs out. We think over the next couple of years that earnings will double, and that's just from a cost out perspective. If they can get some top line growth, then that's sort of that's an added benefit. So that's my stock. Again, thank you for coming. Now, I'll just like to pass it back to Louise, who'll take you through the next part of the agenda. Thank you.
Thanks, Jeff. And before we get into it, I'd like to introduce a surprise presenter this afternoon. Well, I might have spoilt that because I was operating the clicker then. It didn't work properly. But this gentleman is a legend for my money, and he actually works part-time with Wilson Asset Management. Now, I've actually asked all of our presenters this afternoon if they'd be prepared to give me a quirky fact about themselves. It could be a quirky hobby or interest or something similar, because the bios are in the program. I don't want to make it too boring by, introducing them and reading out their bios. But this guest presenter, he's superstitious, like all great sporting stars. I'm not sure whether he's up there with Nadal, but he always puts his right sock on before his left one, and his right boot on before his left one. Now, I think of it, probably most of us do that too, but please welcome Josh Kennedy, co-captain of the Sydney Swans. There you go. There you go. You can do it. You can.
All right. Thank you very much, Louise, for the introduction. Legend's a bit of an overstatement, I think, and also probably part-time too. I think many of the fund managers of Wilson Asset Management would have had a nice little chuckle at at that one, considering it's very, very, very part-time work that I've been doing over the last 2 years at Wilson Asset Management. But very grateful for the opportunity to talk here today. Now, my stock pick, as many of you have heard, and Jeff touched on it briefly, is the first ever listed investment company to offer both social and investment returns for its investors, FGX and FGG. These groundbreaking companies give investors access, as you know, to some of the world-class fund managers. In addition, through FGX and FGG, you're able to have a significantly positive contribution to Australia's future generations. Now, what does this mean? Why am I keen on investing in FGX and FGG? Well, firstly, from an investment standpoint, I'm backing, as again you've already heard, I'm backing first-class investors, all of whom, or many of whom you'll hear from today, but all of whom have been selected due to their long-term track record and performance. In addition, no performance fees. Now, general fund managers charge 15 to 20% on performance. In this case, that remains with you as the investor. And for me, that's something that's really appealing. I think over the time, correct me if I'm wrong, Louise, but the performance fees have totaled since inception of over $40 million, which remains with the investor. That's a huge amount. The other reason that I like the FGX and FGG is because you're naturally diversified through a range of investment styles, obviously backing Australian and international investors. So on the back of that, I think the numbers speak for themselves when you look at not only the performance, but also the volatility over a long period of time. Yep, thank you. So as you can see, the future generation FGX has risen 7.1% with less volatility than the Australian share market. 7.1% compared to 7.5 compared to 11.1. Now, I think every year that Jeff's got up here, he has said that we're at the top of the market over the last 5 years. So in an economic climate that we're in, where high volatility and a lot of uncertainty, that's something that is appealing to me. And then you look at FGG, which has risen 7.3% per annum with 8.5% volatility, again, less than the global market. So on the back of those, and I want to reiterate the fact, no performance fees, which is huge. So over their time as well, FGX and FGG have delivered not only capital growth, but fully franked dividends to investors. Now, if that's not enough to invest, it is only half the story. Since inception in September 2014 and September 2015 for FGG, the combined donation has reached $21.1 million to Australian charities focused at children at risk and youth mental health. And this year, we're on track to reach $10 million in donations. Now, this is on the back that, and again, it's already been touched on, that not only the fund managers not taking any pay, working pro bono, but that extends to board and committee members, as well as service providers. So 1% of assets under management get to go to Australian charities, which is an amazing impact that you can have on Australia's future generations. And finally, I'd like to play a little video to give you a little insight into how the impact can have a real, can really change someone's life.
Without Kids Helpline, I wouldn't be alive. It's as simple as that.
This is Molly. She's 17, lives at home with her loving family, and is being treated for a mental illness.
Molly is the youngest of 4 children. She has 3 older brothers. They're all in their 20s. So after 3 boys, I had my beautiful girl. Molly's been suffering severely with mental illness for many, many years. Much longer, I think, than we ever realised.
For young people like Molly, suicide is now the leading cause of death for their age group.
The first attempt that I was really aware of, was an overdose that she took, and I didn't know. I went off to work the next morning, and the next thing I knew was there was an ambulance calling me. They were at my home. I had no idea. And if she hadn't have called Kids Helpline, and if they hadn't taken the appropriate steps to send the ambulance around, I don't know whether we would still have Molly if it wasn't for the Kids Helpline. Unbeknown to them, they've saved her life on numerous occasions.
Every 90 seconds, a child or young person reaches out to Kids Helpline. With the help of doctors and her family, Molly is slowly turning things around.
Molly is an incredible young lady. I know that in the future she would like to give back. She talks about helping people a lot, but I hope the future includes Molly in my life because she's a very special girl.
There you have it, a real impact, and it's incredible to be able to give back like that. So thank you very much to Louise and Wham for allowing me to talk today. If I do have one more tip, if you're not doing anything tomorrow night, SCG 750, play the Pies. Need all your support. It'd be great to have this many people down there in the cheer squad. Thank you.
You can take that.
Oh, yeah.
Great, Josh. And I know he's just been out injured, but it sounds like he's back on deck and maybe Buddy's there too. So please definitely do that. And thanks so much, Josh. It was fantastic. So now we'd now like to get into the guts of the presentation, and I'd like to introduce our first presenter, Jun Bei Liu from Tribeca Investment Partners. Now, Jun Bei, or JB, as she's happily known at work, is passionate about flowers. She loves being part of a journey where she can nurture and watch the plants blossoming, just like her passion in investing. Jun Bei is patient to find the little gem and support its journey to success. So please welcome Jun Bei.
Thank you very much. Oh, okay. It's great to be here. Now, before I start, I must say what an honor to be part of the manager that's managing the money for future generations, because for such a great cause. Thank you. Now, I want to talk to you about a company today, and that company is certainly going to last a whole lot longer than some of my flower arrangements. The company is called Bravura Solutions. Now, Bravura Solution is a software platform business. Now, I can see a lot of you looking very confused. What's a software platform business? Now, I'll give you an example. Take a bank. Being a customer of a bank, you have a savings account, you have a home loan, and perhaps a car loan with the bank. And more often than not, most of those products you have with them will have a different phone number. So for a simple act of changing your address or your phone number, you have to call up different product individually, talk to different people, so they can change in the different databases. Extremely time-consuming, annoying, and not very effective, and sometimes there's errors involved. Now, it happens because all of those products are built on individual product line, very siloed product lines. Every product line would have its own call center, its own databases, its own a whole lot of costs involved with it, and it doesn't communicate with others. Now, a lot of wealth businesses are built that way. That's where Bravura operates in. Now, those wealth businesses, they have been around for decades. And it's layers of old technology, all built individually. And over the years, it's just become extremely cumbersome and not sustainable in today's modern world. Regulation is changing. Remember the Royal Commission? When they took a look at the wealth businesses, what did they say? They said that they need to be transparent and they need to be fair to all their clients, new clients, old clients. But the issue is, if you don't know what products the clients actually are using and what fees are you really charging them, you don't have that visibility, how would you know? And another thing is, investors like yourself are becoming incredibly sophisticated now. You want flexibility. You want the company to interact with you more often. You want to access those data whenever and wherever you want. You want to access on your iPhone, access on your tablet, and of course, if you take many products from a company, you want a good deal. Why shouldn't you? And with the old system, there's no way of doing that effectively, quickly. So this is where Bravura comes in. It provides a software platform that combines the front, middle, and end office on the same platform. And then all the products can go on at the same time. And these products include life insurance, could include investment products, superannuation, pension, just to name a few. So Bravura serves a critical need for a lot of those wealth businesses. Now, why is Bravura a good company? I can see already showing some of the names of the clients that Bravura has. Now, Bravura operates in the industry where the barriers to entry is exceptionally high. Some of those projects or the spend by those wealth businesses are multi-year contracts. Sometimes it's up to 15 and more years. And it involves millions of dollars, tens of millions of dollars, could be hundreds of millions of dollars in total spend. And those tasks are mission critical. So reliability is incredibly important. And Bravura, have been one of the first mover into those markets, has dominated the Australian market. And they entered into the UK market just a few years ago, and now they're the key player. And you can see some of these key clients. Sticky client, high barriers to entry means Bravura is a very profitable business, makes lots of margin, and it has a very high recurring cost, a recurring revenue. So it has very good visibility in what money it's going to make. And it wins between 3 and 5 clients every single year. Now, so it's a quality company. Why would you buy it now? Well, future for Bravura is enormous. We talked about Bravura has gone to UK a few years ago and become dominant player. Well, it has yet to enter the Asia-Pac market, the US market, which is the largest wealth business in the world. Wealth business is enormous. Just across Asia-Pac and Europe, in total, it's estimated over $115 trillion. And with regulation change and need to modernize, Bravura is well placed, and the spend from those companies at the tipping point to start to pick up. While I say it's not cheap on today's earnings, but Bravura is not a single-year investment case. It's been growing at 20% for the last 5 years on its EBITDA, and it's projected to grow at the high teens for the next 5. This business, in 5 years or even 3, will be a much larger business than it is today. So to sum up, Bravura is a quality company, operates in a very lucrative industry where there's structural drivers ahead, solid structural driver, and we believe it's a very attractive investment at this inflection point of the cycle. Thank you very much.
Thank you. Well done. Thanks, Jun Bei. Fantastic start to this afternoon's stock picks. So our next speaker is Adrian Warner, and he is the Managing Director and Chief Investment Officer of Avenir Capital, one of our FGG fund managers. Now, despite our next presenter having a similar hairstyle to the new Jeff Wilson look, he has 3 daughters, and he's somehow become the internal hairdresser in his household. This morning, he's told me he has already done a high and tight ponytail, a twisted halo, and an elegant fishtail braid that only took 3 attempts before the client was happy. Adrian first got experience in dealing with low-flowing locks when he trained with the Sydney Swans in the 1980s, and he found himself piggybacking Warwick Kappa up and down the stands of the SCG. Please welcome Adrian Warner.
Thank you. Thanks very much, Louise. It's definitely a high-pressure environment in my house in the mornings, there's no question about that. It's a great pleasure to be here and to be part of the Future Generation family. The company that I'm going to talk to you about today is one that you will all know, and it's among the cheapest companies in the world trading anywhere today. General Motors. GM is trading at about 5.5 times PE at the moment. It's more like 3.5 times PE if you out the value of its cruise automation business, which is its autonomous driving or driverless car technology. And we think that's way too cheap for GM for 3 major reasons. The first is that we think that its core automotive business is misunderstood and is a much better quality business than people give it credit for. The second reason is that there has been dramatic cultural change that's been occurring at GM, which is bringing about enormous benefits to the company, and we think those changes are not fully appreciated or fully valued by the market. And the third reason is we think that GM is actually quite well positioned in terms of the future of mobility. So if we take the first of those, the core automotive business, GM makes the vast bulk of its profits in its core automotive business, not from selling cars, which most people think, but from its business selling pickup trucks and sports utility vehicles. And the pickup truck market is a very different market to the car business and has a much more attractive industry structure. It's essentially an oligopoly. 3 players make up 90% of the market. GM has a 35% market share, a leading market share in a very stable industry. There's enormous brand loyalty and very high repeat purchase behavior in the pickup truck market, which can extend across generations. 50% of all pickup trucks are bought not just for personal reasons, but also for work reasons. And many of those trucks are bought in non-urban and rural areas. So we think both of those things make that market somewhat less cyclical than the car market and also provide some protection against the potential threat of autonomous driving, which is often a concern when people talk about GM. So if we look at another industry as a comparison, the Class 8 truck industry, which is the big trucks, the semi-trailers, that has some similar characteristics. It's a 3-player market. It's also exposed to some of these threats from autonomous driving, but that industry trades at 12 to 15 times PE compared to GM at 5.5 times, and we think that disconnect is just too big. The second reason we like GM is that it has undergone dramatic cultural change since the very bruising and brutal bankruptcy the company went through in the global financial crisis. That's shifted the entire focus of the company to return on capital, to generating cash profits, and that's very different from the old GM, which was much more focused on scale and doing anything possible to just sell more cars than anybody else. Since the GFC, GM has reduced its hourly workforce by 50,000 employees, or about a third. It's slashed head office costs by $10 billion a year, or half. It's made very tough decisions like selling its European business, which was losing $1 billion a year, and it cost the company $20 billion since 2000. They've exited entirely from numerous markets like Africa, India, Russia, from large parts of the car or the sedan market. And we think that the change and the benefit of this cultural shift is something that the market doesn't yet fully appreciate and is bringing more and more benefits to GM as time goes by. Which leads us to the third reason we like GM, which is its renewed and very intense focus on electric cars and autonomous driving. GM's cruise autonomous driving business in the last 12 months has raised over $7 billion to fund the development of that business. The last raising was just 2 weeks ago when they raised $1.2 billion, which have valued their cruise business at $19 billion, just the cruise business. And that's compared to an entire market capitalization for the company of about $50 billion. So we think that GM, arguably along with Google's Waymo autonomous business unit, are the 2 leading companies at the moment in terms of the initiatives and activity around autonomous driving. And we think that provides really interesting optionality and interesting potential upside for GM that is not reflected in a price valuation of 5.5 times PE. So we think you can come up to a conservative sum of the parts valuation for GM of more than $60 a share based on what it is today. We think you've got enormous optionality on the upside with the work they're doing in autonomous driving. And there's a whole range of self-help initiatives the company's pursuing right now that we think could add several $1 billion a year in free cash flow to the company's current $4.5 to $6 billion a year of free cash flow. So we think there's lots of reasons to like GM and also lots of reasons to think the market may have got the GM story wrong and to look at GM with a different light from that which we think the market is currently doing. Thank you.
Great, Adrian. Thanks so much. Thanks so much, Adrian. Fantastic, and obviously a big brand that we all know. So our third presenter this afternoon is Ronni Chalmers, and Ronni is the founder and chief investment officer of CBG Asset Management, one of our FGX fund managers. So Ronni, there must be a bit of a theme of flowers going on here because Ronni is a keen grower and collector of Cymbidium orchids. This involves going to various plant shops in June and July of each year and looking for good quality plants, healthy bulbs that he can actually grow and enjoy for the next number of years, long term. Not dissimilar to a successful long-term investment manager. Please welcome Ronni.
Good afternoon, everybody. Thanks for the introduction, Louise. CBG is part of the listed multi-asset wealth management group called Qiao Ma Investment Management. Both CBG and Qiao Ma had their infancy around the year 2000 and 2001. CBG has also been part of the Future Generation fund managers since 2014. So we've been with you now for 4.5 years. I've selected 2 stocks, so I get 2 minutes on each stock. I've selected 2 stocks which I think the majority of the people here probably have not heard of. I'll start with the one that you may have heard of, Lovisa. Lovisa is a chain of jewellery shops operating in 11 countries. It's only been listed on the stock exchange since 2014, so only 4 years. It's been growing very rapidly in that 4-year period. As an example, when they listed, they had 220 stores around the world. Today they have 360 stores around the world, so it's grown by 50% in terms of number of stores. Interestingly, when they listed, Australia was about 2/3 of the number of stores at 158 stores. Today, Australia is only about half the stores, still about 158 stores. Over the next 5 years, they've identified a number of markets where they've made a very modest investment in terms of number of stores, and these markets are multiples of Australia. So as an example, in the US, they have 8 stores today. That compares to 155 in Australia. In Spain, they have 8 stores. In France, they have 7 stores. And in the UK, they have 36 stores. Potentially, all those countries could have more stores than the 158 in Australia today. The stock was listed at $2 a share. We actually did not partake in the IPO at $2 a share. That was a poor call. The stock was priced on about 12.5 times PE, and it was priced on about a 5.5% dividend yield. Fast track 4 short years, the stock is $10.20 today. It's got $1 billion market cap. It's in the ASX 300, so it's not quite in the ASX 200, and I'll come back to that in a second. The largest shareholder in the company is probably a name that is arguably Australia's best, or at worst case, second best retailer, Brett Blundy. Jeff earlier on talked about Solly Lou. Well, I'd say both those 2 names are the best 2 retailers in Australia today. So Brett Blundy is chairman and largest shareholder with 41% of the register. A couple of negatives and positives about the company. Interestingly, with so many stores, they only went live with their e-commerce site in October 2018. A couple of positives, a couple of metrics like the cost of doing business is 50%, and that's going to continue to fall as they grow their stores. Gross margins 3 years ago were 74%. Today they are at 81%. Shop turnover, so when they get the products in their stores, they actually sell those products within 3.5 weeks. The next best company in the stock exchange is Premier, which is majority owned by Solly Liu. They have a huge stock turnover, but theirs is 6 weeks. So they are turning over their stock every 3.5 weeks. The other thing about the company is the average price of the product is $10 to $15. So they can perhaps fight the competition online because people just want to buy a little gift. They want to go out and feel good. And for $10 and $15 and $20, they're still making huge margins. Another negative to flag to you is this can be a very volatile stock. As an example, in December 2015, it was $3.80. 2 months later, it had halved to $1.96. By the end of 2016, it had doubled to $4.10. A year ago, the stock was $12.50. 6 months later, in December 2018, it had halved to $6. We bought the stock at $6.15. The last sale is $11. And it trades about $3 million a day, so there's plenty of liquidity. Thank you.
Thanks, Ronni. And Ronni also asked me to mention that he runs an identical portfolio to what's in what he's managing in FGX via his LIC called CBG Capital, and the code is CBC if you want to check that out. So now I'd like to introduce our next fund manager, Alison Savas. And Alison is a client portfolio manager at Antipodes Global Investment Partners, one of our FGG fund managers. Now, Alison's got an interesting quirky fact. In another life, short and sharp, Alison would have been a race car driver. So please welcome our RevHead portfolio manager, Alison.
Thanks, Louise.
Just the big green one.
Gotcha. So if I had to take a guess at the one issue which was consuming businesses all around the world, I would guess that it's disruption. Competition is increasing everywhere, and in part because of the arrival of the cloud, which has lowered the cost of capital of starting a new business, and in doing so has lowered barriers to entry. We've seen some great examples of disruption. We've seen it, for example, in the transport industry with the arrival of Uber, in the lodging industry with the arrival of Airbnb. Now, if we think back a few years ago, the market didn't believe that traditional software businesses could transition to remain relevant in a cloud-centric world. And many of them have made that transition, and Microsoft is a great example. We believe there is still one software incumbent that has transitioned its business, but remains cheap relative to its growth profile and its peers, and it's SAP. Now, the concept of using an ERP system to increase the efficiency of your organisation isn't new. In fact, it's been around for more than 40 years. It began in the 70s as a system which planned parts requirements for production schedules and developed in the 90s to integrate business processes like manufacturing, distribution, accounting and HR. But in the world that we live in today, data is the competitive advantage. So the ability to capture it, analyse it and integrate it back into the business in real time has never been more important. To remain competitive, businesses need to become digitally native, and that means invest in their IT systems, and ERP is a critical component of this. The ERP market is worth about $100 billion US. SAP is the leader. It has a 25% market share, more than 2 times the size of its next competitor. Now, it is a fragmented market as customers use multiple software providers. Customers do use multiple software providers because what's happened is that over the years, new competitors have emerged, digitally, internet-enabled firms like Salesforce.com and Workday. So they've taken market share. but SAP is fighting back through its own product development and also through acquisitions. SAP has had the most significant product release in almost 20 years through its S4 ERP software, which only runs on its own HANA database. Now, by doing this, allows them to take a greater share of the customer wallet. Now, bear in mind that a product cycle will typically last 10 years, and we are just at the foothills of this. And about half the customers who have signed up are brand new to SAP. The company's also made some clever acquisitions, which have transformed SAP into a critical software stack, which goes beyond ERP now into human capital management and sales and marketing, so now encroaching on traditional CRM. Now, while the market might remain concerned about SAP's ability to integrate its acquisitions, we see a company that's already delivering, because it's the only ERP software that provides companies with a complete end-to-end solution that captures data, analyses this data, and integrates it back into the business, whether that be by automation or a better user experience or digitisation of the product or smarter pricing. So regardless of whether you are a hotel or an airline, or whether you make mobile phones or widgets, SAP is the only ERP software that can provide you insights right from the design of your product or service all the way through to insights on the customer experience, and feed these customer experience insights back into the design of your product or service. So SAP closes the loop and also enables the complete digitisation of the enterprise. And let's not forget that SAP is the incumbent. So with that comes several advantages, like scale and customer lock. Now, by increasing the breadth of their portfolio, we believe that increases customer lock. And in that, they can take market share. So we see a company with an accelerating growth profile as it enters a period where it harvests the investments made in its own product and through acquisitions. Now, despite this, SAP remains cheap, both relative to software companies listed globally and also relative to its own history. So we see a favourable risk-reward opportunity with SAP. Thank you.
Thanks, Alison, so very much. So now we're just going to set up, and I'm going to invite Hamish Douglas from Magellan and Tony Boyd from the Australian Financial Review up on stage for an in conversation. And just a quirky fact about both of them, just as we're setting up. Now, with Hamish, I was intrigued to know that when he was younger, he was terrified of public speaking. Well, I have to say, I'm not sure when you had that fear, but you certainly haven't got it these days, and we'll be hearing about that shortly. Now, with Tony, this is a fascinating one. Tony was an Ethiopian soldier in the first large-scale production of Verdi's Aida at the Sydney Opera House in 1975. It was a very high-paying job, I've been told, thanks to Actor Equity's penalty rates. I hope they're paying you a bit better at the AFR these days, Tony. Tony qualified for the job, along with 30 others, because of the quality of his marching on B Company in the Waverley College Cadet Unit. His unit was the only one with red berets, which encouraged esprit de corps. So please welcome Hamish and Tony to the stage.
Well, Hamish, thank you for coming today. I know someone with a business as large as yours, with the global scale. I think, is it 60 billion under management now?
It's a little larger than that, but
okay.
we
won't dispute the billions.
In US dollars, it's about right.
Great. Okay, well, for those in the audience want to do an exchange rate, that's we're getting up around 80, 90. But I thought I'd start by asking you, there's a lot of things going on at the moment. We've got the trade war between the US and China. We've got market volatility. We've got Brexit. We've got the Donald. He might be on Twitter now or possibly at 2 a.m. this morning. Who knows? But what's on your mind? How are you reading the situation at the moment?
Yeah, well, there's obviously a lot of noise going on. And as an investor, you have to kind of distinguish between the noise and what's really relevant. And I would say, you know, we have Brexit and we've got a lot going on in Europe. We've got tweets happening every moment in the United States. So how do you distinguish between this and what's really going to drive markets and drive economies? I'd say there's two big things on our minds, Tony. The first I would say is the trade dispute with the United States and China. And you have to make an assessment of whether or not there's going to be deal or no deal, because underlying this is a very, very deep strategic issue between the nations. We've now got a very large emerging nation who is challenging the United States for economic supremacy in the world and military supremacy in the world, and it's never faced a foe like this before. The Soviet Union was never an economic foe, so they sort of fought proxy wars in Afghanistan and Vietnam and other places. But now they've actually got a foe who can challenge them economically. And I actually think Trump isn't right about a lot, but he's actually right about the core issue here. And the core issue is actually they appear to be doing it on unfair terms. They have been stealing intellectual property. They've been requiring foreign companies who come and participate in their massive market to effectively transfer their intellectual capital as a cost of doing business. If they can't get it, they go and steal the technology through their cyber theft. They have massive state-owned enterprises who get huge subsidies, and they use those subsidies for taking market share on a global scale. So that is a very, very real issue, and they're trying to reset that relationship. And China has a plan called Made in 2025 plan that's outlined a list of industries it wants to dominate in the future. And that list of industries is absolutely incredible. It includes autonomous vehicles, artificial intelligence, quantum computing, 3D manufacturing, aircraft, spacecraft. A fascinating one is deep sea space stations. I didn't even know there was such things as deep sea space stations, but I guess if you want to own the moon, you may as well own under and the rest of the planet here. So they've got very big ambitions. But the big question is Trump just doing this for political purposes, or is he doing it because he's really want to reset the relationship? It appeared up until 2 weeks ago, it looked like it was just a deal to be done. And to protect his stock market. It's become a little more uncertain in the last few weeks of whether or not this is actually going to be resolved. We could get into a severe sort of trade war, Cold War environment, or we could actually have it settled. And it is very difficult to know which way this coin's going to flip. The markets are pricing that Trump is going to do a deal with President Xi. That's what the market environment is. Obviously, it got a little bit jittery over the last few weeks, but still the assessment of markets is a deal's going to be done. Our best assessment is that's probably the most likely outcome, but there are political overlays. What is the best thing going into the presidential election in 2020? Maybe a dispute with China and immigration should be the big topics to be fighting, and we're not a socialist country, I'd say it's the third thing. So that whole issue is taking up a lot of our time, and we spend to a lot of experts in Washington and China and other places in assessing what the pulse is at the moment. The second big issue, and I would say this is even a more important issue, is really what's going on with US monetary policy. And the reason it's so important is because when you're an investor, you have to make an assessment about where interest rates are going to be in the future, because risk-free interest rates effectively set the discount rate. Warren Buffett refers to interest rates as the gravity of markets. When interest rates are low, assets are worth more, and when interest rates are high, assets are worth less. And historically, you could normally go to some very liquid bond markets like the US long-term treasuries and the German bunds, and it would tell you what that risk-free rate was. You'd add a risk premium and you'd use 8 or 9% as your sort of discount rate. And all we had to do was try and forecast the cash flows between now and Judgment Day and discount them back. That's not easy, by the way. But now we've got two moving parts. The market doesn't really know what the discount rate is anymore, because the central banks came in with massive monetary printing exercises known as quantitative easing, and they have taken these rates down in Germany to 0, Do we really think interest rates are going to be zero infinitely? In the United States, long-term rates are 2.5% to 3%. I can tell you if long-term interest rates are 2.5% to 3%, most equities in the world are currently a bargain. But if they go back to where they were sort of more historically around 5%, most markets are pretty expensive at the moment. So this is why this is such an important topic. And we went into December last year, the US Federal Reserve had a very steady program of increasing interest rates, and they said there'll be more gradual interest rate rises this year, and we were factoring that into our thinking. And in January, they did a backflip and said, well, we're not going to do that anymore. And a big question you have to ask about the future is, what is inflation and growth going to be? Because that's going to factor into this equation. So we spend a lot of time thinking about that in us assessing whether markets and assets are attractively priced or not.
Well, just one question that comes out of your description of what's going on between the United States and China. Yeah. Earlier in the week, the Financial Times raised a question in editorial whether we're going to end up with two separate, I suppose you might call, strategic technological silos in the world. And they're those that are supported by the United States, and then there's those that will be supported by China. Is it going to get to a point, do you think, where investors and countries have to really decide which one they back, or can you back both in the belief that ultimately the most efficient and most, I suppose you'd say, powerful capital investor, which is probably going to be China, will win?
Well, I'm not sure it's determined China's going to win at the moment. Do I agree that we're entering a world with effectively two technology silos in the world? I think that is right. The Chinese internet has the Great Firewall. So you can't actually participate within China as a Western firm if you're in there, and they've banned a lot of players being in that market. And it's a very, very important market, and it's literally a completely separate world. But we've also got a race, I would say, in two very important areas of technology, and it's not autonomous driving. I would say it's a race for quantum computing and also a race for artificial intelligence. And whoever wins the race for quantum computing can effectively decode any cryptography in the world. And that means if you had a nation who actually got a true quantum computer developed for another nation, they could effectively break in and control the whole nuclear arsenal of the other nation. That would actually be quite an advancement into who's more dominant. And if you think about the next phases of artificial intelligence, we've got something known as narrow artificial intelligence. So when you go on your Netflix and you get the films being recommended to you, what you get recommended and I get recommended, you probably have operas being recommended to you by the sound of it.
These operas are quite good.
That's just artificial intelligence. It's learning what you watch and your habits and knowing things about you. Facebook, which you get in your news feed, is forms of narrow artificial intelligence. What the next stage of artificial intelligence is something called artificial general intelligence. And that is some way off in the future, but whichever nation gets there or enterprise who gets there first has such a significant strategic advantage, as in it's astronomical, the advantage that would cause, and there is an arms race. China is putting ridiculous amounts of capital behind quantum computing and artificial intelligence. I think the United States is waking up, but they're putting only $1 billion into quantum computing at the moment. I cannot believe that they are not doing this. And I think they've realised that then in order to get there and the advancements of this, they're sending all their students to American universities and literally sucking out the intellectual capital. And I think that's what America's woken up to. There's a very, very big game going on here.
Well, I mean, just as way of background, a couple of years ago I interviewed Michael Birchuk, who is at the University of Sydney working on quantum computing, and part of his work is financed by DARPA, which is an American, I suppose, pseudo-military R&D financing arm. So we are partly in the race, even here in Sydney. But just to return to this question of the silos of technology, your top 10 stocks are dominated by technology stocks in America, and the biggest threat that I see to them is regulation. there's a very interesting anecdote. We probably have got time for it. Just before the election, Scott Morrison and several of his cabinet ministers had a meeting with Facebook and Google up in Brisbane, and apparently it was actually toxic in terms of these people from these two technology companies came totally unprepared, and the Prime Minister was absolutely ropeable. And there were some absolute, I think, things that couldn't be repeated in this room. Said to these representatives, you are not taking this seriously. This was in the wake of the terrorist attack in New Zealand. I just wonder, and I only use that as a background to the question, are the companies too arrogant? Are they in a situation where they're going to be either broken up or put in a less favourable commercial position?
Yeah, it's obviously a topic that we spend a lot of time on, and I spend a lot of time in Washington seeing staffers of various senators who are putting proposals up. I'm about to go in a few weeks again to see some more people in Washington. So we're really trying to stay on the pulse of regulation. And you're right, we've got some very big positions in Alphabet and Facebook, which I would say at the front end of this. We've got Microsoft not quite in the same zone, Apple in a slightly different position. So what are the big issues on the regulatory side? And I would say at the end of the day, our Prime Minister may have been a little bit opportunistic about what was going on to want to take some action. This isn't something that gets regulated by opportunistic short-term moves with something going on with Christchurch. There's a whole series of regulatory issues that have to be grappled with. One of them is who is responsible for content on these platforms. At the end of the day, these platforms have billions of users. So there's 2.3 billion monthly active users on Facebook. There's 2 billion users on YouTube. So they're putting up their content on these platforms, hundreds and hundreds of millions of posts a day, if not billions, depending which platform you're on. And therefore, when it gets put up, how do you make the judgment call that what is being put up is a real opinion? This has got free speech and other things into this. The biggest issue we have to think about is whether or not the governments are going to turn these platforms in publishers, that they become totally accountable for what's going on. As far as we see in any jurisdiction, that when they look at it in detail, none of them want to turn them into publishers. When you go at the UK inquiry, when we think about what's going on the ACCC, when it was going on in the United States, but what they want to do is to make them accountable to effectively get really bad content off their platform and do it really quickly and have surveillance technology on their platforms to ensure they're monitoring this. And if they don't have all of that, then make them accountable in terms of criminality or fines. So that's one issue. Election meddling is another issue, and they're spending enormous amounts of money on that. Competition policy are they going to break these up, or are they going to put behavioural undertakings like the EU and fine these things where they may be promoting their own services on their platform over third-party services on their platforms? Privacy is a big issue, and obviously the Europe has been leading, has sent a model of something called the General Data Protection Regulation. We think that will get rolled out around the technology companies are pleading with the politicians to regulate them on privacy, and they can't get the politicians to agree with each other to do anything about it, which is staggering. They're actually asking to be regulated, and still they can't do that. And there's another issue about the data that is stored on these platforms, who it belongs to, and whether it is portable or not, and truly allowing the customers to either get their data deleted or could take it to another service. So it's a very complex topic. It's just not one issue. It's a multifaceted issue. I would argue that 2 of our investments are probably at the pointy end of this, but if you look at something like Facebook, the Facebook business is one of the most incredible businesses of the 21st century. It is growing at 30% a year, its core sort of Facebook advertising business, but they have a whole series of other businesses that haven't even been monetized. They've got their messaging platforms, which is WhatsApp, Facebook Messenger, and the Instagram messaging platform. 2.7 billion users, and they're currently not earning any revenue for that. And I'll tell you, they'll earn an enormous amount of revenue there. They're now turning their Instagram business into a commerce business where you can do in-app inside the app direct purchases for goods that you see, you can tap on, see something wearing and purchase, and they're running out. So not just advertising, but a transaction commerce business, and a massive video advertising business, which is coming out of the Facebook business. There's $225 billion of advertising revenue on television and pay television ex-China in the world, and there is a massive shift of viewership away from traditional forms of entertainment, as we know, with a Netflix, and there are going to be very, very few players who collect most of that advertising revenue, and I'd argue that YouTube, which is owned by Alphabet, and Facebook, which is developing, they have within 18 months of developing something called Facebook Watch, which is the video tab. They've got over now 100 million users in 18 months watching over 1 hour a day of video on that platform, which is now starting getting advertisements. Netflix, which is worth $160 billion, has 130 million users.
That's fantastic.
So all we say is these businesses are incredible. The regulation you have to watch out for. We're there because we know the businesses are fantastic. We're wary about the regulation.
We've just been told we've got 5 minutes left, but I thought, first of all, on Facebook, we'd take that as a stock tip, I think. I bought the stock at 210 several years ago and then sold out at 270. I noticed how Warren Buffett got in at 190, much smarter man than me. But I wonder if you could just comment on a paradox before I ask the room for questions that I see at the heart of this whole technology thing. The Chinese want to get access to American capital markets. So I was told by someone at Morgan Stanley the other day that there's a big pipeline of Chinese tech companies wanting to come to America, like Alibaba did, and list there and get all the advantages that go with that. Are you at all interested in those types of opportunities, or is China for you just too risky because of these geopolitical developments?
Well, let's start at China. If you have a look at the emergence of the purchasing power of their middle class, it's probably got 300 million consumers in their middle class. There's forecasts from McKinsey and others of 600 million within 5 years. Even if that happens in 10 years, you're talking between 7 and 15% growth per annum in the size of their middle class. The size of their middle class is going to be twice the population of the United States of America. And the effect of that, if you can participate in that consumption, is incredible. We're primarily there through US-owned entities, but we're cautious that the US and China are in this Cold War potentially that isn't going to go away. Even if they settle this trade dispute, these tensions are not going to disappear. So we're thinking about how we can access that Chinese middle-class consumption story, which is a scale the world has not seen. And is going to grow for 20, 30 years. This is a very, very long-term thing. So how do you participate in that beyond what we're doing in owning something like a Starbucks or an Apple or a Yum Brands or McDonald's or something? If you could buy Nike, who's got a very large presence there as well. But there are other businesses. Luxury goods is a very interesting area. So much of the growth in luxury is coming through China. Now, but there are some very large Chinese direct businesses who have fabulous businesses that we would buy, and they are listed and owned in China. You've asked the question about Chinese tech. I don't want to get into the individual names. Yes, there are a number of the Chinese tech we would buy. They've got structures that are not ideal. They're set up as foreign investment vehicles through something called VIE structures, but they don't actually own the business. The business is typically owned by a bunch of individuals, and the structures are technically illegal in China. Which adds to a risk. We're not saying that risk is, but there is potentially a higher risk there. It all comes down to valuation to us and how to participate versus. So you ask yourself, would you own a Facebook or would you own a combination, or would you own Tencent, which is kind of a combination of Facebook and a gaming company? You think up the valuation multiples and you think about the opportunities, and we made an assessment we'd prefer to own Facebook at the moment than Tencent. We may be right, we may be wrong, but would I own some of those Chinese tech companies at the right price, taking the risk into account? But I'm probably more interested in that long-term consumption story and how to access that. And there are Chinese, there are European, and there are American great companies who have fabulous positions
in China. Okay, well look, this is like winning the lottery. There's time for one question from the floor. I won't ask my colleague from the Financial Review. I'll ask someone out there who's obviously you're all fans of Jeff Wilson, so nobody's excluded. Yes, just down here.
Thanks for the opportunity to ask the question, and Hamish, thanks for your time today. Given where the world is today and we are where we are, in 5 years' time, when you're sitting there talking about your past 5 years' performance, what do you think would be a good outcome to be able to report?
I can tell you in 5 years I won't have any more hair. Look, we tend to be very long-term investors in what we do. And I would imagine that many of the investments we have today, a good outcome would be that they're still investments we have today and we have in 5 years. If you think about our investment in Starbucks that we have, it's up 57% or something in the last year since we've bought it. I don't get excited that it's up 57%. So if I think of when we bought our investment in Yum Brands back in 2007, it was $22. Yum Brands is now equivalent with Yum and Yum China, about $140 a share. So I would hope we're on a journey with some of our great investments. We bought Visa Card in 2012. We've made over 7 times our money in Visa Card. We bought Microsoft in 2014. 5 years later, we bought it at $28 a share. We made our largest investment. Today, Microsoft is $130 a share. So I would hope, looking out 5 years, some of these investments and these seeds we've got in the ground today are on their way of what I call the magic of compound interest. Benjamin Franklin, who was one of the founding fathers of the United States, had an incredible quote. He had a quote that said, money makes money, and the money that money makes more money. And that's what investing is all about. It's all about the ability to compound your money over time. And I would hope in 5 years' time, we're still on that journey with some of these great businesses, compounding our investors' wealth. And I would say that's just a point on a journey that will be a journey in 10 years and 15 years from today. But exactly what that's going to be in 5 years will a bit depend on markets and other things. So I don't have a particular number, but I have a journey in my mind.
Okay, well, look, we've only got about 30 seconds, so I thought I'd ask you 2 quick questions. Your biggest regret?
My biggest regret would... the 2 biggest investment regrets would be that misreading a Tesco and Kraft Heinz. We've got a big position in Kraft Heinz. If anyone noticed, it didn't go well this year. And we got overconfident in sort of the 3G management capability there. What's the greatest achievement? I think, like most people in this room, it's your family. It's not about making money or anything. It's about your kids, and it's about the journey that they're on, and it's about things that you can do as a parent. And I said, actually, at my 50th, when I was speaking, I was really speaking to my kids. I was speaking to everyone there, but I was speaking to the kids. And someone asked, well, what do you want to be remembered for? And I just had a very simple thing, that at the end of the day, you want to be remembered by your kids that they were great parents. It's not about getting remembered about how much money you make or anything else, or having your names on buildings or anything else. I think it's the job you do with your kids is the most important thing.
Well, I fully agree, and I think that this is why I love what Jeff Wilson is doing with what's in this room at the moment. The amount of help that is given to people who need it, who are living in Australia, who either can't get help or just for some reason or other need help from charities. I think it's a wonderful thing. So thanks, Hamish, today, and we wish you greater prosperity in the future.
Thanks,
and
Tony.
all your members. Thank you.
Thank you very much, Tony and Hamish. I mean, it is mind-blowing, some of those numbers that Hamish is talking about, and also how he's grown that business. I mean, Magellan was founded in 2006. We're only talking about 13 years ago. And what is it, 90 billion? I mean, it is quite extraordinary. And I think you can see why when you heard him in conversation with Tony just now. So back to our stock picks. So now I'd like to introduce Blake Henricks. And Blake is the Deputy Managing Director and Portfolio Manager of Firetrail Investments, one of our fund managers in FGX. Now, if you heard one of the investment forums last year, Blake featured at that, and we heard about his very quirky habit that he's obsessed about board games. I think he's got over 200 board games, which is quite extraordinary. But the other thing he loves is surfing. He's surfed in some far-flung places around the world, including Morocco, and he's also been in Indonesia for 2 tsunamis over the last 20 years. Please welcome Blake.
So the investment idea I wanted to talk about today is an ASX-listed company. It's got more employees than BHP, Telstra, and even the Commonwealth Bank. But it's not in the ASX 20. It's a company with a majority of its revenue coming from long-term recurring revenue style contracts. The company is Downer Group, and they specialise in urban infrastructure. We'll come back to this in a moment. There's a bit of a quiz here, so just keep this in the back of your mind. We'll come back to this in a moment. But what do Downer do? Well, it's urban infrastructure. They design, build, and then manage pieces of urban infrastructure. So think about roads, rail, schools, universities, hospitals, power stations, everything that helps more and more of us living in the same little spaces and the population's growing. There's 3 reasons I really like Downer. The first is for the quality of the earnings. The second is for the valuation, which doesn't reflect the quality of those earnings. And then finally, there's a few catalysts on the horizon, which I think can close the valuation gap. So let's talk about the quality of the earnings, because when you think about infrastructure, many of you probably think about money being flushed down the toilet, because that has been what's been happening in recent times in infrastructure. RCR Tomlinson recently went into insolvency as they won so much work, they couldn't execute it, and they're no longer around. Lendlease has lost hundreds of millions of dollars. And just along here, we've got the Sydney Metro, which by all accounts is down about $1 billion for the person building it. So it's been a terrible space for anybody who's been building these projects. But Downer is very different. They don't do large-scale, fixed-price contracts on one-off projects. They specialise in this urban infrastructure, much more manageable. And so if you think about the kind of things they do to bring it to life a little bit, here's some of the things that Downer work on. That's what they've got in common. I showed my wife this slide last night, and she actually said it reminded her of one of the Google questions, you know, click on the traffic lights to make sure you're not a robot. So it's not that hard, because I find those excruciatingly hard. The top left there is ANU Student Campus. This is where 3,750 students are housed. This is one of the 10 buildings. Downer have a 20-year contract to manage that site. The top right is the MCG. Downer has been involved in managing that facility for decades, including the marquee days like the AFL Grand Final. The bottom left, it's a little bit less glamorous. It's the South Auckland Correctional Facility, the jail. Downer's got a 20-year contract to manage that. And then on the bottom right is a train pulling into Olympic Park. It's a Waratah train. The New South Wales government has bought 100 of these trains from Downer over the past few years, and earlier this year they made a purchase of another 17. That contract for those 17 trains and the maintenance comes to $900 million. So when you think of Downer, I want you to not think of big fixed price infrastructure blow-ups. I want you to think of small-scale, manageable infrastructure and the maintenance on the back of it. So let's talk about the quality of the business, because that's the second reason I like Downer. When I think about the quality of the business, there's a couple of things. The first is that it's got growth coming for many, many years because of everything that's going on. But the second is that the cash flow conversion of the business is very, very high. In the last 7 years, Downer has converted 90% of its earnings into cash flow. That's a very, very remarkable number. So you've got a really high quality business that's going to grow for many, many years. Then we get to valuation. And this business, which is going to grow above the market, it's going to grow this year earnings about 13%. In future years, it'll probably be growing high single digits. It's trading on a 15 times price to earnings ratio, which is less than the market. So it's a business with long-term recurring revenue in a growth market, high cash conversion, but it's on a sub-market multiple. One of Downer's biggest problems is it doesn't have listed comps in Australia. There's no business like it. You actually have to go to the UK to find companies like Serco and Compass. They're trading on closer to 20 times PE versus Downer on 15 times. And so finally, what's going to bridge the valuation gap? It's this. I was reading the AFR, Tony Boyd and Co. Apparently, Downer's looking at selling their mining services division. It's going very well at the moment, but it's about 13% of earnings and it's a lot more of their capital. If Downer was to exit that business, you would be left with a business that's even more recurring revenue, less capital intensive, and that would be a good thing for the multiple. The second thing on the go is that Downer manages the Royal Adelaide Hospital. That's a loss-making contract. It's a long-term contract, and I think any resolution of that would be quite meaningful for the sentiment around the stock. So that's Downer. You've got a quality business on a great valuation with some near-term catalysts. Thank you. Thanks, Liz.
Thanks so much, Blake. So I'd now like to introduce our next presenter, which is Qiao Ma. And Qiao is from Cooper Investors, and she's a portfolio manager there. And I'm pleased to say that, Cooper, they're actually involved in both companies, FGX and FGG. So there's an incredible generosity from Peter Cooper and Qiao and the team for supporting both companies. So literature is Qiao's second love after investing. For years, she moonlighted as a columnist for a Chinese magazine and published a book on Chinese students in America in 2008. But another interesting fact about Qiao is that investing is in her blood. Her father was one of the earliest stock traders in China in the early 1990s. She was in primary school then, and she volunteered to be his chartist. Every night, she read the stock prices off the newspaper and charted the closing prices on a huge piece of paper that covered the entire living room wall. Please welcome Qiao.
Thank you. Just on this. Thank you, Louise and Jeff, for having us here today. It's been a huge personal honor, and good afternoon to you all. I have to say it takes a lot of courage to come here today and pitch a Chinese company, but I'm going to do exactly that. I was sitting there being nervous while a lot of interview and feeling the room, and I just have to share with you something I always tell myself in times like this. It's a quote by Warren Buffett that says, "Be greedy when others are fearful." That being said, we are stock pickers at Cooper Investors, so let's go back to the business fundamentals. If any of you have someone in your family between the age of 10 and 25, you probably have noticed just how much time they spend playing games, either online or via a console, most likely to your annoyance. Esports is a phenomenon describing when people watch other gamers, usually with skills higher than their own, play in competitions or tournaments. At Cooper Investors, we believe in observation and not prediction. And we're saying esports is not a phenomenon that's distant in the future. It is happening today. It is a global phenomenon, but particularly big in a country like China with almost 500 million gamers. So let me just give you a sense of how big this phenomenon really is. The biggest mainstream sport in China is soccer. So last year, the World Final for soccer attracted 50 million viewers. Impressive. A few months later, the championship final for a popular online game called League of Legends, where the Chinese team actually won for the first time. And yes, there are national teams for video games as well. That event got 70 million people to tune in. And I myself have been to a few of these events, one of them being shown on the big screen today. I can tell you when you're sitting in the room, the enthusiasm, the electrifying energy from the viewers and the gamers is every bit as intense as an AFL game. Huya is one of the 2 platforms online in China where you can watch these video games. The feel and look of Huya looks a lot like YouTube, but it's a very specialized website with just gaming content. It has a staggering over 120 million people visit this website on a monthly basis. Huya is based in Guangzhou, a city you probably have heard of in southern China. We went to see the management quite a number of times at its headquarters, Guangzhou is known for exports and manufacturing, but not so much for internet companies. Huya's management team, the style is very typical to a southern Chinese management style. It is down to earth, it's not flashy, it does not make the prettiest website, but when it comes to things that matter the most to users, which is quick video showing, low latency, Huya is best in class. You might have heard a lot of young and very popular companies in China or in Silicon Valley that never make any money. Well, that's not Huya. It is actually already profitable and generating real cash flows for its investors. Huya has attracted some of the smartest investors in the space. 30% of the company is owned by Tencent, the largest and most successful company in China, which you might have heard of. The vote of confidence from Tencent means two very important things. One, the financial prospect. By our calculations, everything that Tencent has ever invested in over the past 10 years returned about 25% per annum. So that's pretty impressive. And second, 90% of all the games broadcasted on Huya are actually owned by Tencent. So making alliance with your biggest supplier essentially not only give them a secure pipeline for future games, but also keeps a lot of the competitors who don't receive such voting or blessing by Tencent at bay. So we like Huya, and then we think it is building a really serious long-term competitive moat around its business. It's a classic platform business. The flywheel is very simple but powerful. It goes like this. The viewers like to go where the broadcasters are because that's really where the content is the best, and the broadcasters like to go where the viewers are because that's where they make the most money. To sum it up, we think Huya has very favorable current operating trends, very positive long-term structural industry structure, and it has a very specialized focused management team. Thank you for your time.
Thank you. Thanks, Qiao. I think that was pretty persuasive. I think I might have a look at that one myself. I know my husband's tuning in on the live stream, so thank you very much. So next up, we have Justin Braitling, and he is the founder and chief investment officer of Watermark Funds Management. And Watermark is one of our FGX fund managers. Now, I had a little bit of trouble getting a quirky fact out of Justin, but I do know that he's definitely learning the guitar, and he just hasn't got it with him up on stage today, but I'll be checking in on the progress. Thank you, Justin.
Thanks very much, Louise. Today I'd like to talk to you about EML Limited. EML is a payments company. It's been around for quite a while. It has two businesses, reloadable debit cards and gift and reimbursement incentive cards. They started out in gift cards many years ago and are now operating in 21 countries and have 1,200 programs running around the world. The payments are facilitated like any other debit card that you may keep in your wallet or via a token that you would have embedded into your smartphone using an Apple Pay, an Android Pay or a Google Pay. The first opportunity in credit cards, which we're really excited about, is in Europe. So in Europe, typically gift cards are provided by malls, and it's a very profitable business for them. The average gift card typically has a balance of about 10%, which is unspent, and the card just gets thrown away, and the mall operator gets to pocket that margin, which is a nice business for them. Unfortunately for them, under the EU's new payment services directives, it's going to become a lot more onerous for malls to run their own programs, and they're looking to outsource these gift card programs to companies like EML. EML is the largest gift card provider in Europe, and they've just bought number 2 last week, making them a clear leader in Europe. They currently have 600 odd malls signed up, and there are 10,000 malls in Europe. So, we think that they will continue to sign up European malls as the malls get out of their own programs, and we see very exciting growth ahead for EML in Europe. Now, the second business they have is in reloadable cards. So, this is like the debit card that, again, you might put in your wallet. And this particular product has resonated in salary packaging and in sports betting in particular. And so EML has a fantastic business here in Australia where one in every two of the punters betting online will put those transactions through their reloadable card provided by EML. These are companies like Bet365 and GVC, which owns William Hill, sports betting companies you may be familiar with. Now, the big opportunity here is in the US. So up until recently, it was illegal to bet online in the US. There has recently been a Supreme Court directive which has allowed a pathway through to legalisation for online sports betting in the US. Now, New Jersey is the first state to have legalised this, and all the big global sports bet-making companies are flocking to the US to gather their customers as quickly as they can and build a business. So now what we like is the fact that EML already has relationships with all of these companies, not just in Australia, but in the UK and in Europe. And so we think that they will look to EML as their preferred vendor for these reloadable debit cards as they roll out their businesses in the US. So in just a couple of years, we think the US will be bigger than the rest of their existing business in the gift cards business and here in Australia. So it's a very exciting opportunity. We value the company at $3 a share. It's currently trading around $2.35, so there's 30-odd% upside in the share price. Again, they've just acquired the second largest player in Europe. The US opportunity is unfolding as we speak, and it's a very, very exciting opportunity. So get on board. We think EML is going to do very well in the years ahead. Thank you.
Thanks, Justin. Fantastic. Okay, well, definitely our last presenter is known very well to me. It's Martin Hickson, who's a lead portfolio manager at Wilson Asset Management at WAM. He's the lead portfolio manager for WAM Active, and he's the joint lead portfolio manager for WAM Capital and WAM Microcap. I've actually got a couple of quirky facts about Martin, and that's because some of my colleagues at WAM have helped me out here, so he doesn't know about these. But firstly, Martin's wife bought him a paragliding voucher for his birthday, and when he decided to use it, apparently the paraglide crashed into the sea, and he actually had to be cut away from the parachute. So we're actually quite lucky that Martin's here, is the first quirky fact. But the other one is that he's obsessed about chili con carne. So he's known to cook a very mean chili con carne and live off it for a week because there's so many different meal options that you can do with chili con carne. He thinks it's great on rice, toast, corn chips, the list goes on. So if you've got any suggestions of recipes, please email Martin at wilsonassetmanagement.com.au. Please welcome Martin.
Thanks, Louise. Might point out that was over a decade ago when I had the chili con carne obsession. It was when I moved out of home and I didn't know how to cook much else, so I used to live on it. Think childcare. Over the next 5 minutes, I'm going to talk about why we think it's one of the best microcaps in the market and why we've just bought 4% of the company. So what do they do? As the name would suggest, Think Childcare operate in the childcare space. They operate 59 childcare centres, primarily in Western Australia and Victoria. So why invest in childcare? Well, as a father of 2 young kids, I'm reminded every month when I get my childcare bill just how profitable these businesses are. We also think that the Australian childcare industry is at an inflection point, and it's about to enter a period with reducing supply and increasing demand. So firstly, the supply side. After 6 years of large increases in new childcare supply, driven by easy access to credit, more recently, banks have reduced the amount that they're willing to lend to childcare developers. We believe that over 2019, new childcare supply will fall by 10 to 15%. And this will make it easier for existing operators like Think to fill their excess capacity. Secondly, on the demand side, in July last year, the government increased the childcare subsidy. Low-income families are now up to $2,500 better off per annum. Over 95% of Think's families are now much better off under this new policy. And so we believe that this new policy will lead to increases in demand and improvements in occupancy. So why is occupancy so important? A childcare centre operates on a largely fixed cost basis. For Think Childcare, 84% of the company's costs are made up of wages and rent. As a lot of these costs are fixed, as every additional child enters a childcare centre, the incremental profit on that child is very, very high. Currently, on our analysis, we believe that Think's centres are operating at around 75% occupancy. And for every 1% increase in occupancy, this adds 5% to their earnings. We also think that, also based on our recent industry analysis, we believe that over the first 4 months of this calendar year, occupancy levels across the industry have increased by between 2 and 3%. So what makes Think Childcare different? Nido. In October 2017, Think acquired a leading premium brand known as Nido. They offer increased levels of education, entertainment and service for parents and can therefore charge a higher average day rate. The Nido centres also operate at higher levels of occupancy. Think are currently in the process of converting their whole portfolio to the Nido brand, and currently today, 25% of their centres have already been converted. So what about management? The CEO and founder of Think is a gentleman called Matthew Edwards. He established the business back in 2009 when he acquired 12 childcare centres. The business was listed on the ASX back in 2014, and since then has generated shareholders a total return in excess of 20% per annum. He remains highly aligned with other shareholders and continues to hold 23% of the company shares. So what are the numbers? Think currently has a market cap of $100 million, has a dividend yield of 3.9%, which is fully franked, trades on a price to earnings ratio of 10 times, and has earnings growing at 30%. We believe that over the coming years, as they execute on their strategy, continue converting their centres to the Nido brand, and continue to increase occupancy levels, we think that Think's shares can trade at $2.40, which is 45% above where they're trading at today. So this is why we think Education is one of the best microcaps, and why over the last 4 months, we've bought 4% of the company. Thank you.
Thanks, Martin. Great. Thanks very much, Martin. And I think that stock pick is quite appropriate given the name and what we're up to here with the future generation companies. So I hope you've got some gem stock picks from this afternoon. Just by way of a quick show of hands, who'll be back next year if we do it again in May? Excellent. Secondly, would you recommend it to a friend? Make sure you do bring that friend next year as well. Please promise me that. Now, we're going to send you an evaluation survey, and please be brutally honest, because every year we want to try and improve how we actually do this event. So we look forward to your feedback. But please join with me in thanking all of our presenting fund managers this afternoon, and also our in conversation with Hamish Douglas and Tony Boyd, and of course Josh Kennedy as well as our surprise presenter. So thank you everyone for being here. Thank you everyone, and goodbye.